Let me tell you something that most people completely misunderstand about their retirement income. Right now, in 2026, there is a significant development unfolding with Social Security that could mean an extra $500 coming into your bank account every single month. Now, I know what you are thinking. You have heard these claims before, and most of them turned out to be nothing but hot air. But here is where clear thinking becomes absolutely essential. The truth is, this is not about some magical new benefit that suddenly appeared out of nowhere. What we are actually seeing is a combination of legitimate cost of living adjustments, supplemental benefit programs, and state level initiatives that many eligible recipients simply do not know exist. The tragedy is not that these programs are unavailable. It is that roughly 40% of qualified individuals never claim what is rightfully theirs because they do not understand the requirements or do not even know these opportunities exist. Think about that for a moment. Money sitting on the table unclaimed while people who work their entire lives struggle to make ends meet. That is not just unfortunate, it is unacceptable. So let us break down exactly what is real, what is available right now, and whether you actually qualify. Now, before we dive into the specifics of who qualifies and how you can determine if you are leaving money on the table, I need you to understand something fundamental about how government programs actually work. You see, the government operates on a principle that I have observed throughout my decades in business and investing. They do not come knocking on your door to give you what you are entitled to. They publish the rules, they create the programs, and then they wait for you to figure it out and apply. It is not malicious, it is just bureaucracy. And bureaucracy, by its very nature, favors those who are informed and persistent. The recent changes we are seeing in Social Security are not happening in a vacuum. They are the result of economic pressures that have been building for years. Inflation has eroded purchasing power at a rate we have not seen since the early 1980s. The cost of healthcare continues to climb at multiples of the general inflation rate. Housing costs, whether you are renting or own your home, have become burdensome for people on fixed incomes. Congress and the Social Security Administration have responded to these pressures, but understanding their response requires us to look at several different pieces of the puzzle simultaneously. Let us start with the most straightforward piece, the annual cost of living adjustment, or COLA as it is commonly known. Each year, Social Security benefits are adjusted based on the Consumer Price Index for urban wage earners and clerical workers. Now, that is a mouthful, and frankly, it is not a perfect measure of what seniors actually spend their money on, but it is what we have got. For 2026, we are looking at a COLA increase that for the average beneficiary receiving around $1,900 per month translates to a meaningful bump. But here's what most people miss. This adjustment varies based on your benefit amount, and when combined with other programs, it can indeed approach or exceed that $500 monthly figure we are discussing. The second piece of this puzzle involves Supplemental Security Income, commonly called SSI. This is a needs-based program that is entirely separate from your regular Social Security retirement benefits. And this is where a lot of confusion enters the picture. Many people assume that if they are receiving Social Security retirement benefits, they cannot also receive SSI. That assumption has cost countless people thousands of dollars in benefits they were legally entitled to receive. The reality is more nuanced. SSI is designed for individuals with limited income and resources, and yes, you can receive both Social Security and SSI simultaneously if your retirement benefit is low enough and you meet the asset requirements. Now let us talk about those asset requirements because this is where clear thinking becomes absolutely critical. The current resource limits for SSI are $2,000 for an individual and $3,000 for a couple. But not everything you own counts toward these limits. Your home does not count regardless of its value. One vehicle does not count. Personal belongings and household goods do not count. Life insurance policies with a face value under a certain threshold do not count. What does count are things like bank accounts, stocks, bonds, and other financial assets. The key insight here is that many people who assume they have too much to qualify actually do not when you properly calculate what counts as a countable resource. Here is something else that requires careful attention. There are state supplementation programs that work in conjunction with federal SSI. Depending on where you live, your state may add additional money on top of the federal SSI payment. California, for instance, has one of the more generous state supplementation programs. New York has its own version. These state programs can add anywhere from $50 to several $100s to your monthly payment, and they are available to anyone who qualifies for federal SSI. The tragedy is that people often do not apply for SSI because they think the federal payment alone is not worth the hassle of applying, not realizing that their state might double or triple that amount. Let me give you a concrete example of how these programs stack together because this is where that $500 figure starts to make real sense. Imagine you are a widow receiving a Social Security survivor benefit of about $200 per month. You live in your own home, which is paid off. You have about $2,500 in your checking account and maybe another $300 in savings. You drive a 12-year-old car. Based on this scenario, you would likely qualify for SSI because your countable resources are well below the $2,000 limit, and your Social Security income is below the threshold. The federal SSI payment could add several $100s to your monthly income. If you live in a state with supplementation, that is additional money on top. When you factor in the recent COLA increase to your Social Security benefit, you are looking at a total monthly increase that could absolutely reach or exceed $500 when compared to what you were receiving just a year ago. But we are not done yet, because there is another layer that most people completely overlook: the Medicare Savings Programs. These programs help pay Medicare premiums, deductibles, and co-payments for people with limited income and resources. There are several different levels of these programs, each with different income limits and different benefits. The most comprehensive is the Qualified Medicare Beneficiary Program, which pays your Medicare Part B premium, your Part A premium if you have one, and your Medicare deductibles and coinsurance. For someone paying the standard Part B premium, that is over $170 per month right there. When you add in the savings from not having to pay deductibles and coinsurance when you visit the doctor, the total value can easily exceed $200 to $300 per month in reduced healthcare costs. That is money that stays in your pocket instead of going to medical bills. Now, I want to address something that I have seen cause tremendous confusion and missed opportunity: the relationship between working and receiving benefits. There is a widespread belief that if you are receiving Social Security retirement benefits, you should not work at all because you will lose your benefits or face punitive taxation. This belief is largely incorrect and has prevented many capable seniors from supplementing their income when they both wanted to and were able to work. The reality is that once you reach your full retirement age, which is between 66 and 67 depending on when you were born, you can earn as much as you want from working without any reduction in your Social Security benefits. Before you reach full retirement age, there are earnings limits, but they are higher than most people think. And the benefit reduction is not permanent. Your benefits are recalculated upward once you reach full retirement age to account for the months you had benefits withheld. What does this have to do with that $500 monthly boost we are discussing? Simple. If you are between 62 and your full retirement age, understanding these earnings rules can help you strategically maximize your income. If you are past full retirement age, even modest part-time work can supplement your Social Security and potentially lift your total income high enough that when combined with COLA increases and any supplemental programs you qualify for, you are seeing a substantial increase in your monthly cash flow. The key is understanding the rules so you can make informed decisions rather than operating based on outdated assumptions or rumors you heard at the senior center. Let me talk now about a program that is gaining traction in several states, but remains almost completely unknown to most beneficiaries. Property tax relief and rent rebate programs specifically designed for seniors receiving Social Security. These are not federal programs, so they vary considerably by state. But in states where they exist, they can represent significant monthly savings when annualized. Pennsylvania, for instance, has a property tax and rent rebate program for eligible Pennsylvanians 65 and older. New Jersey has a similar program. Illinois provides property tax relief for seniors. When you receive an annual rebate of $1,000 to $2,000 or more, that is the equivalent of an extra $80 to $170 or more per month in your budget. Combined with everything else we have discussed, these state-level programs contribute to that overall increase in available monthly income. There is also the matter of prescription drug assistance programs, both federal and private. The Social Security Administration works in conjunction with Medicare to provide extra help, also known as the low-income subsidy, for prescription drug costs. If you qualify for this program, your Medicare Part D premiums can be reduced or eliminated, your deductibles can be reduced or eliminated, and your co-payments for prescriptions can be dramatically reduced to just a few dollars per prescription. For someone taking multiple medications, which describes most people over 65, this program can save $100 to $300 or more per month. Again, this is money that would otherwise come out of your Social Security check that now stays in your pocket for other expenses. Now, here is where we need to apply some serious critical thinking to the question of eligibility. The programs I have described all have different eligibility requirements, different application processes, and different administering agencies. The Social Security Administration handles retirement benefits and SSI. The state Medicaid agencies handle Medicare Savings Programs. Your state revenue department handles property tax relief. It is fragmented, it is confusing, and it is designed in a way that almost seems intended to discourage applications. But that is exactly why understanding the landscape is so valuable. The people who do the homework, who take the time to understand which programs they might qualify for, and who actually submit the applications. These are the people who end up with significantly more monthly income than their neighbors, who are in virtually identical financial situations, but who never bother to investigate their options. Let me be very clear about something, because I do not want anyone walking away from this with unrealistic expectations. Not everyone will qualify for every program. Not everyone will see an extra $500 per month. But here is what I know to be true. Most people qualify for more than they are currently receiving, and most people have never systematically investigated what they are entitled to. The question is not whether you will get exactly $500 more per month. The question is whether you are going to leave money on the table that you worked your entire life to earn and that you are legally entitled to receive. The application process for these various programs requires documentation. You will need proof of income, which means your Social Security benefit statement and any other income sources. You will need proof of resources, which means bank statements. You may need proof of residence and citizenship. The paperwork can seem daunting, but think about it this way. If it takes you 6 hours total to gather documents and fill out applications, and those applications result in an extra $200 per month in benefits, you have just paid yourself over $400 per hour for that paperwork time. That is a pretty good return on investment for your effort. There is also the matter of retroactive benefits for SSI. You can potentially receive benefits going back to the month you filed your application, assuming you were eligible at that time. For Medicare Savings Programs, there may be opportunities for retroactive coverage of premiums. The point is, even if you think you might have qualified for programs in the past, but never applied, it may not be too late to recover some of that lost value. Every month you delay investigating your eligibility is another month of potential benefits you are forfeiting forever. I want to address one more critical point before we wrap up this discussion, and it has to do with the mindset that I have seen prevent people from accessing benefits they have earned. There is a peculiar American phenomenon where people view claiming government benefits they are entitled to as somehow shameful or as accepting charity. Let me be absolutely clear about this. Social Security benefits are not charity. You paid into the system your entire working life. SSI, Medicare Savings Programs, and other safety net programs exist because we as a society decided that people who worked hard, played by the rules, and reached retirement age deserve a basic level of dignity and security. Claiming what you are entitled to is not taking advantage of the system. Failing to claim what you are entitled to is letting the system take advantage of you. The truth is that navigating these programs requires patience, attention to detail, and persistence. You may need to call the Social Security Administration multiple times. You may need to visit your local Social Security office. You may need to contact your state Medicaid agency, your state revenue department, and possibly your area agency on aging. But each of these contacts is an investment in your financial security. The information is available, the programs exist, the money is real. What is required is the initiative to pursue it and the persistence to see the application process through to completion. That is not asking too much for potentially thousands of dollars per year in additional income and reduced expenses.